The top business stories live from the Sky News City studio. Wages growth slows sharply as higher interest rates lead to a softening of the labour market. Ofcom announces plans to tackle mid-contract price rises for phone and broadband customers. Plus, the food and household goods giant Unilever is facing investigation over some of its environmental claims. Good morning, this is Business Live with me, Ian King. Wages growth has slowed sharply in the latest evidence of how high interest rates are impacting the economy. The Office for National Statistics said this morning that average pay, not including bonuses, in the 3 months to October was up 7.3% on the same period last year. That was down from the 7.8% in the 3 months to September. The ONS said this was the sharpest fall in the rate of earnings growth since the 3 months to November 2021. Meanwhile, the number of job vacancies in the UK economy in the 3 months to November fell by 45,000 to 949,000, marking a 17th consecutive month of contraction. Meanwhile, the unemployment rate for the 3 months to October was unchanged at 4.2%. Well, joining me this morning is Simon French. He's Chief Economist, Managing Director at Panmure Gordon. Simon, good to see you this morning. I mean, it does look as though wages growth is slowing rather rapidly than expected.
It is, and if you're looking for signals on the Monetary Policy Committee at the Bank of England for the type of data they need to both justify the pause they're in, but potentially start talking about interest rate cuts, this is the sort of data, the wages data, that they were looking for. But let's not pretend that wage inflation north of 7% is consistent with the 2% inflation target. It isn't. But the directional now is consistent with a labour market that is cooling. And the debate, not just in UK macroeconomics, but global macroeconomics, is can you pull off something of a soft landing? It's not a phrase I particularly like, but it's one that everybody uses, where you can deflate demand, but not undershoot into a jobs recession. And that unemployment data, the last data point you picked up on, is quite encouraging. Less encouraging is the inactivity picture, but on unemployment, you know, if you'd offered most economists, 3 years on from the sort of peak of the pandemic, an unemployment rate still around 4%, given all the trials and tribulations post-pandemic and energy spike, they would have bitten your arm off.
Absolutely. And it's worth pointing out that according to the ONS, the actual rate may even be lower than 4.2%.
Indeed. Well, you're alluding to the fact there's a lot of conflicting data points, partly the fact the ONS is having real difficulty in its labour force survey of getting sufficient responses to really know what is going on. And you're right, there are conflicting pictures from the single-month estimate, the labour force survey, the workforce survey as well, in terms of workforce jobs. But I think it just illustrates, for those people trying to make policy off the back of this, got to proceed with a degree of caution at the moment because the data is telling you quite a conflicting picture. But underlying that is still, for some of the asset markets or like the housing market that are worried perhaps of job losses lead to, forced selling, that really isn't crystallising. So that demand lever, suppressed by higher interest rates, not really passing through at that kind of rate.
Yeah, now the number of vacancies fell for the 17th consecutive month. It's worth pointing out there are nearly 1 million job vacancies in the economy. Yeah. I mean, the number of vacancies to the unemployed is roughly 1 to 1, isn't it? I mean, it's still pretty tight out there.
It is. If you look at the long-term average, 20-year average number of vacancies the UK economy runs, it's about 700,000. So you're absolutely right. We're still more than 250,000 north of that figure. So that suggests decent underlying demand. But remember, that has come down from 1.3 million. And this comes back to the point we mentioned at the start of this interview. Do you undershoot in terms of labour demand weakening, but it's set now on a path with interest rates passing through to households with higher debt servicing costs for at least the next 2 years, almost agnostic of what the Bank of England does as they all refinance at higher rates. That's the real challenge, whether those vacancies will remain elevated against that backdrop.
Yeah, you mentioned the inactivity rate just now. I mean, obviously there's been a lot of focus from the government on trying to get that down. Doesn't seem to be working.
No, it's a slow impulse, but give the government some credit, not a phrase I often utter, but they are in the right space. I think if you look at working age activity, it's probably about 750,000 lower than it would have been had the pandemic not happened. So there's clear scarring evidence in the labour market. The challenge for the government is to know whether the levers they're pulling on childcare, on universal credit, on national insurance changes we heard at the autumn statement last month, whether that is going to have an impact. Now, they convinced the OBR, the Office of Budget Responsibility, to score a change in availability of additional workers. They don't need to convince the OBR. They need to make the real economy respond in the way that they hope. It's not going to happen quickly in the data.
Yeah. Just to go back to something that you mentioned just now, why is unemployment so difficult to measure just now?
Well, the labour force survey, which is our, if you like, the internationally recognised way of measuring the unemployment rate, we've had a non-response problem, particularly amongst younger workers, younger households, who are just not responding to the classic, phone call to landlines. It's a bit of a 21st century problem, if you like, of sampling. So what the ONS are trying to do is triangulate that survey data with the payroll data they get from the Her Majesty's Revenue and Customs. But of course, that omits some of the workforce, the self-employed most obviously, but then also there is a bit of a revision that comes through in HMRC returns from employers. So you are flying a little bit blind with conflicting data points there, but mainly as a result of the changing way in which households respond to these surveys.
Yeah, a very difficult job for the Bank of England to ascertain what's going on here. I mean, you've already alluded to this. You don't think this is going to move the needle for this Thursday's MPC meeting. What is going to need to happen for the MPC to start thinking seriously about rate cuts?
Well, I know you like a sort of blunt, short answer, so I'll say, well, the Federal Reserve have got to cut rates. To some extent, and this isn't a criticism of the Bank of England, this isn't a criticism of the UK economy, it's just an observation. The monetary policy around the world has been pretty collinear with the Federal Reserve. So if you look at the ECB, you look at the Bank of England, the Bank of Canada, the Reserve Bank of Australia, their hiking cycles and their cutting cycles will take their cue from the Federal Reserve, unless they want their domestic currencies to move pretty strongly, which has inflation or demand implications. So ultimately the answer is not so much domestic data, which is why I actually disagreed with the CBI's forecast earlier in the week that talked about rates not being cut until 2026. That's a bit tone deaf as to focusing on what's going on in the UK economy when, honestly, what happens in the US will dictate the bandwidth that the Bank of England has to cut interest rates.
Yeah. Simon, got to leave it there. Good to see us ever this morning. Thank you.
Pleasure.
Some other business news stories for you now. And the food and household goods giant Unilever is to be investigated by the Competition and Markets Authority for environmental claims made in its advertising and marketing. The watchdog, which has been carrying out a wider investigation into so-called greenwashing, said it's concerned that Unilever may be overstating how green certain products are through the use of vague and broad claims, unclear statements about recyclability and natural-looking images and logos. The investigation will include looking into whether claims about some ingredients are presented in a way that may exaggerate how natural the product is and so may create an inaccurate or misleading impression. The drugs giant AstraZeneca is spending up to $1.1 billion as it looks to build up the vaccines business that it established during the pandemic. The company, which rolled out a vaccine for COVID in partnership with the University of Oxford, is buying the US biotech company Icosavax. The Seattle-based business has a potential vaccine for two common respiratory diseases, RSV and human metapneumovirus. RSV alone kills up to 10,000 adults in America each year. Shares of both Hargreaves Lansdown and AJ Bell fell by more than 8% each this morning after they were among 42 firms contacted by the Financial Conduct Authority, setting out its concerns on the way they deal and said it may not reasonably reflect the
Fly Emirates, fly better. Thank you.
Welcome back. Apologies, we had a few sound issues, but I'm pleased to say they've hopefully now been resolved. Return now to the other business news stories I was telling you about this morning, and shares of both Hargreaves Lansdown and AJ Bell have fallen by more than 8% each this morning after they were among 42 firms contacted by the Financial Conduct Authority, setting out its concerns on the way they deal with interest earned on customers' cash balances. The watchdog said a majority of the firms contacted retained some of the interest earned on those cash balances and said it may not reasonably reflect the cost to firms of managing that cash. The FCA said many also charge a fee to customers for the cash they hold, known as double dipping, which has told them to stop. Sales of non-food items in UK supermarkets fell during the last month as shoppers delayed Christmas spending to take advantage of special offers on groceries. Data provider NIQ said that during the 4 weeks to the 2nd of December, sales of non-food items were down 7.7% on the same period last year. It said total sales growth at UK supermarkets slowed to 6.8% during the period on a year-on-year basis, down from 8.7% during the previous month. It said a quarter of all supermarket sales during the month were made from items on promotion, which was the highest level since February 2020. Well, last night's gains on Wall Street were followed by a positive session overnight for stocks in the Asia-Pacific region. I can show you the picture there, all of the main indices in positive territory. Hong Kong was the star performer. Elsewhere in the region, the main stock index in Thailand is on the point of entering bear market territory. Well, in Europe, stocks all largely actually, they're a bit mixed now. I mean, the DAX dipped into negative territory, and so is the IBEX in Madrid. All eyes, of course, later on today, we get the US inflation data. That's the key thing people are looking out for today. Talking points today include Pepco. That's the owner of Poundland, of course. It's listed in Warsaw. The shares have fallen by 1.5% today following a trading statement. Well, here in London, the FTSE 100 is in positive territory, up just under 0.5%. And today, in fact, it hit its best level since the 18th of October, amid strength in healthcare and mining stocks, a big heavyweight section that is. Rio Tinto is the leading percentage gainer on positive broker comment, while Hargreaves Lansdown and St James's Place are both lower on that letter from the FCA to financial services providers. Meanwhile, BT and Vodafone are lower. That's on Ofcom's proposals to ban mid-contract inflation-linked price increases. More on that later in the programme. Outside the FTSE, AJ Bell and Aberdeen are lower on the FCA letter, while the aerospace and defence contractor Chemring, quite surprised to see this one, it's off by 1.5% despite raising its dividend by a fifth and reporting better than expected annual sales and profits. On the foreign exchange markets, well, the US jobs data had very little impact on the pound. As you can see, they're very slightly higher against the dollar, down by 0.25% against the euro. The single currency up by 1/3% against the dollar. As for the oil price, that continues to trade in a very narrow range after last week hitting its lowest level since the end of June. A barrel of Brent crude will currently set you back $75.73 a barrel, and that is off just under 0.2%. Well, joining me now is Priti Rathi, the Senior Investment Director at Investec Wealth and Management. Pretty good to see you this morning. Like to get your thoughts on this investigation into Unilever, first of all. I mean, it hasn't had much of an impact in the share price.
It hasn't, you're right. The shares have barely moved this morning, so I would suspect that it's not a particularly share price sensitive development. And actually, we've seen quite a few companies overseas go through this process. So Coca-Cola, Danone, Nestle have all been investigated recently for their potential greenwashing. Unilever is no different, and it's probably just an obvious candidate for investigation. A lot of the consumer goods companies want to make sure that their products are natural or recyclable in part or in all. And it's actually just quite fresh off the press this morning. The UK Competition and Markets Authority have launched an investigation into Unilever's claims.
That's a big week for central banks this week. Obviously, we get the Federal Reserve, and then in Europe here, Super Thursday, we get the Bank of England, the European Central Bank, and I think the Swiss National Bank as well. Yes,
I think it's fair to say that we're not expecting any movement in terms of rates from any of the three major central banks, i.e. the Fed, who are meeting this evening, the ECB and the Bank of England. What will be really interesting to investors is from the US what the updated dot plot looks like, i.e. what the rates predictions or projections are for next year, and also what the inflation projections are. Investors have had a really positive view of whether we are approaching a rate cutting cycle. And it'll be interesting to see whether that is confirmed or indeed if the Fed start to be a bit more forward looking with their projections, given that we have seen inflation figures coming down quite sharply.
Yeah, I guess actually the US inflation numbers, which we also get today, that's probably the big market event this week, isn't it, given what you've just said?
Absolutely. It's quite a quiet week broadly for macroeconomic data. So as I say, I think the investors really will focus on the central bank meetings and, more importantly, the rhetoric that goes around those central bank meetings, which will contain the messaging that the central banks want to get across to investors.
Now, of course, we're still getting a fair few trading updates, unusually for the time of year. One that caught your eye is Adobe, which I think updates Wall Street tomorrow.
Yes, so Adobe, the US company, focuses on software, and in particular, AI has been, or artificial intelligence has been, a really hot topic for investors of late. And it'd be interesting to see whether Adobe has made any progress in monetizing its AI. Firefly is the art and creative suite of products that Adobe offer its users, and it'll be interesting to see what the company reports in terms of its progress there. Also, the market will be looking at whether any of the macro weakness has impacted demand for its products. We suspect it's unlikely, but again, the artificial intelligence aspect is really the key here.
Yes, we had Adobe senior management on fairly recently talking about Firefly, actually, on the programme. Another one you're looking out for this week is Inditex, the owner, of course, of Zara.
Indeed. So Inditex, as you say, fast fashion, 75% of its stores are Zara. So a lot of people will know Zara very well. And Inditex, in September, at their last results, they talked about potentially having quite a good reaction to their autumn and winter lines. But the reality was September and October were quite warm in a lot of, or warmer than usual in a lot of the UK and Europe, which delays people buying their winter coats and so on and so forth. So it'd be interesting to see how much demand they've had for their autumn-winter collections. Additionally, they've gone through a process of closing down their lower performing or lower quality stores in the last year or year and a half and focusing on their higher quality stores, which no doubt will have impacted its margins. So a lot to come out of the trading updates from both Adobe and Inditex tomorrow.
OK, Preeti, we've got to leave it there. Good to see you again this morning. Thank you.
Thank you.
Now, the communications regulator, Ofcom, has proposed banning telecoms and broadband companies from imposing inflation-linked price rises in the middle of a customer's contract. The regulator said that as of April this year, 2 in 5 broadband customers and more than half of mobile customers were on those contracts, subject to these terms. It says that in future, where companies' contracts provide for any price rises during the contract period, they must set this out up front in pounds and pence. It says providers should also set out when any changes to prices will occur. Well, joining me now to talk about this is Richard Tang. He's Chief Executive of the Rochdale-based internet provider Zen Internet. Richard, good to see you this morning. Are you surprised that Ofcom has suggested this?
A little bit surprised, to be honest, but really, really happy because the industry needs it and consumers need it. I mean, for so many years, the broadband industry has been really tricking consumers by signing them up on one price and then hiking their price mid-contract in a way that consumers don't understand. And Ofcom has said, enough is enough. You need to be clear. If you're going to charge one price and then put it up to another price, you need to be clear what that other price is. So really good news.
It seems to be more pronounced among mobile operators right now than it does among broadband providers.
Well, in the broadband industry, all the big players do inflation-linked price increases currently. So they say every year we're going to put your price by CPI plus typically 3.9%. So it's an inflation-busting rise. And look, the average consumer is not going to go to the trouble of saying, I'm going to sign up for 2 years. My price is going to go up once, then my price is going to go up again. What do I think inflation is going to be? Let's add the percentages. And so, I mean, it's rife in the broadband industry, and there's only Zen and a few other broadband providers that think that's unethical and don't do it.
Do you think Ofcom's going to get its way here? What needs to happen?
I think Ofcom, well, I very much hope Ofcom will get its way. Zen will certainly give its full support to the consultation, which ends in February 24. And I've got a feeling that with the lobbying from the consumer organisation, which as well, that they will get their way and that it will be brought in, Ofcom say 4 months after the decision, which is due in the spring. So July, August 24 should be when all broadband providers have to be clear in pounds and pence if there are mid-contract price hikes. To be honest, it would be better if there were no mid-contract price hikes at all, which is what Which has been lobbying for. So you're just clear with customers, you know, you're paying this, it's an 18-month, 2-year contract, and that's what you're going to pay. I mean, that's what Zen does.
What's the situation in other jurisdictions, Richard? Is this sort of arrangement fairly commonplace on mainland Europe, for example?
I'm not sure what's going on in Europe, whether Europe is better or worse than the UK, I'm not sure.
But I mean, this is bound to get a bit of pushback from the operators, not least because it's going to eat into their profits, one would assume.
Well, the share prices have spoken this morning, haven't they? And so I guess, yes, it will eat into their profits, but you've got to ask yourself, what's more important for the big players to make more profit at the expense of consumers not knowing what they're going to pay, or is it better for consumers to know what they're going to pay, particularly with the cost of living crisis, and for the big players to manage their business models appropriately? I'd certainly vote for the latter.
I hear what you say, Richard, but I mean, if you take the case of Vodafone UK, I mean, they're trying to launch with Three UK right now precisely because they say, such is the structure of the market, there are too many players in there, they're not even achieving a return on their capital at the moment.
Well, there are a lot of reasons, stroke excuses as to why these price hikes need to go in. But, I mean, Zen's been running for 28 years without implementing mid-contract inflation-busting price hikes. So I just don't accept that these companies need to hike their prices by an amount that consumers don't understand and an amount above inflation because of the state of the market. I just don't accept that.
How did we get here in the first place? Why did this become commonplace?
Well, it's been going on for years, and the big players used to hike their prices even without putting it in the small print, and Ofcom really came down on that. And then what they did then, they kept hiking the prices, but they put it in the small print. Okay, still not a great thing for the majority of consumers. I think only 16% of broadband consumers and 12% of mobile consumers were aware of that. First of all, they had a mid-contract price hike. Secondly, it was linked to inflation. So I think it's been just a thing that's been endemic in the industry for years and years of the players trying to get market share.
Richard, I'm sorry, we're out of time, I'm afraid. Have to cut you off. Good to see you again this morning, sir. Thank you.
Great to see you.
That's it from me. I'm back at 4:30 this afternoon. Hope very much you can join me for that. Up next, it's Jane Secker. Cheerio.